Here are the top 3 reasons why we believe 2024 is going to be bullish. And I just want to let you know right now, if you're a bear, you're going to absolutely hate this video. My name is Hamilton. I'm here with the Trading Initiative. If you like this type of content, please like and subscribe. Leave a comment below. Without further ado, let's kick it off with all-time highs in the S&P 500 today. Again, all week, all-time highs. We do believe that this is a breakout into a new uptrend, potentially reaching upwards of $550 on the S&P 500 over the extended year / into next year. We do have a long-term bullish outlook. Let's go ahead and talk about exactly why. First things first, you're going to notice this is the Stock Traders Almanac. We're going to come back to this. Didn't actually want to start there. We're going to start with, once again, secular / cyclical bull and bear markets. As of right now, it's going back to 2013. We are in a secular bull market. If you have not watched the previous video we put out about the difference between secular bear and secular bull markets, it's incredibly impactful. I'm not going to take the time to go through it exactly like I did in the last video right here. Just understand that we are in a secular bull market that started in 2013. These things usually last 15 to 20 years, meaning over time, higher highs are going to be more substantial than lower lows. We're generally going to be in an uptrend over an extended period of time, and we are smack dab in the middle of that. We have another 6 to 10 years to go in this secular bull market, meaning every single pullback should represent an opportunity to buy that over an extended period of time. Once again, secular bull market. I don't write the rules. The data's right in front of you. You can either ignore it at your own peril or play along with it. Understand that we are in a long-term uptrend. Let's go to the number 2 reason why we believe 2024 is going to be a very bullish year. Don't have to look any farther than this 4-year presidential election cycle. Going back to 1949, you can see that during the 4-year election cycle, we generally move up and to the right, which shouldn't surprise you because markets tend to move up and to the right over time. But what this particular chart does is it segments out each year and kind of gives you a framework of what you can expect based off of data going back to 1949 about whether or not each year within that 4-year presidential cycle is on average bullish, bearish, or neutral. And as you can see here, this particular chart was posted in June of 2023. So I just want to point out, June of 2023, you can see that the solid lines are current trends or current trends as of June of 2023, and the dotted lines are historical averages. All right. If you think about 2023 and how it played out, we saw Q3 show in some sort of corrective move, right? We can go back and actually look at that on the charts here from July through the end of October. We saw about a 3-month run of weakness, a correction back to the 200-day moving average. This is a 10% pullback. That is a correction, not the beginning of a new bear market. And as you can see on this particular chart, it shows that in the end of Q2, beginning of Q3 through the end of Q3, we generally see some weakness. I'm not saying that this has to play out exactly 1-to-1, but it does give you a framework based off of historical data to support the fact that those are buyable pullbacks, not the beginnings of bear markets in that 3rd year. And then guess what happens at the end of the 3rd year, the Q4? It generally ramps. As you can see, we ramp up off of the lows, that corrective phase, and what happened in the end of 2023? Well, we ramped off of the lows into damn near all-time highs at the end of 2023. As you can see, we bounced 16 to 18%, and it's even more pronounced in the Q. So once again, this is not a 1-to-1 trade. This is exactly how it is, but it gives you a general framework to be able to objectively look at price action and go, is this really a time to panic or not? It's not. It's absolutely not. Now let's look at the 4th year here. As you can see NASDAQ, S&P 500, Dow Jones Industrials, all positive on average during the 4th year of the presidential election cycle. What are we seeing right now? All-time highs in January. What we see through about the middle of Q1 is that prolonged uptrend, the continuation of the 2023 or 3rd year ramp, and then we see a little bit of consolidation through Q2 into an end of year ramp, specifically around the election dates, which I think is important to understand. These do match up with election dates. All right, so 4th year, let's actually look at it more in depth. We can see that this is actually the 4th year, the election year. Look at all of the election years, that black line. Is it up or down on average? It's up. So once again, bears, I'm sorry, you're fighting historical trend and data here, but maybe this time is different, right? But I think the most important part here is that sitting president running. Look at the green line. Now you can extrapolate this out. Historically speaking, when a sitting president is running for re-election, the 4th year of the presidential election cycle is very, very bullish. I don't get political on this channel. To be quite honest with you, I don't give a fuck about what you think about politics. But what I know for sure, at least as of right now, January 24th, 2024, Biden is running for re-election. which fulfills this sitting president running requirement. And if that continues to be the case, is it unfathomable that we could be at double-digit profits in the S&P 500 once again at the end of this year? No, it's not unfathomable. As a matter of fact, it happens on average. It happens on average, which is pretty crazy to think about. Now, there's probably a million reasons why. Accommodative Fed, accommodative monetary policy, getting the potential voters in the best possible financial situation they can to try to garner votes. Sure, why not? Does it make sense why that this takes off at the beginning of November? Once again, key dates within the presidential election cycle matter. Yeah, it could be all of them. Who gives a shit? I don't care about your politics. You don't care about mine. But we do know that data going back to 1949 supports a bullish 2024, specifically Q4 of 2024. So if you're a bear, you're fighting historical trends and data sets. If you're a bull, buy the best stocks leading in the market and sit tight. That is number 2. All right. And I want you to be able to, if you want to pause this actually is from the Stock Traders Almanac. I bought it. Highly encourage you guys, if you are market historians or like raw data, go back and look through this stuff right here. Right here is your last piece, number 3 from the Stock Traders Almanac. There's a saying in the market that as January goes, so goes the year. Just put it out in the newsletter today. As January goes, so goes the year. You can look at the data here from 1950 to 1969. It doesn't format well on the computer. Unfortunately, there's the entire data set if you actually buy the book and load it up on a Kindle or if the hard copy. But essentially what this is telling you is if January closes green, which as of right now, we have 1 week left. We do have Tesla earnings after hours and a couple other big earnings coming up early next week. But as of right now, we're up on the month about 2.6%. If January closes green, over 80% of the time, the market also closes green that year. As a matter of fact, the data is right here, 83.6% accuracy ratio. That as January goes, so goes the year. If January closes green, 83.6% of the time, the market is going to also close green going back to 1950. Now, if you want to factor in flat years, which are plus or minus 5%. Those are not technically big pullbacks or big pop-ups. Those are more neutral. The accuracy does drop slightly to 72.6. So if you factor those in, as January goes, there is still an overwhelming edge in the direction that January closes. And as you can see, if you buy the book, you get the whole data set. I'm not going to go ahead and format it here for this particular video, but it goes all the way back to 1950. This is a lot of data here to look at. An 83.6 accuracy ratio is fucking insane. If that was your odds in a casino, you would be banned the first day you were there. So to take a bearish stance in 2024, I just want to point out, is going back against trend, is going back against historical data, and you are betting that this time is in fact different, because going back half of a decade or more, it shows you that 2024 is probably going to be a pretty bullish year. The last thing I want to point out, for those of you that still expect a recession, I'm not an economist. I do have 2 degrees in economics, both of them completely worthless to what we're doing in the market. They're going to get you in more trouble than not. But for those of you that are still in the recession camp, I have one question for you. If we look at real gross domestic product, real GDP, and we go back to 2022, we go Q4 of 2021, we have 21,800. Q1 of 2022, 21,700. Q2 of 2022, 21,700 and less. Is this not a technical recession? Is this not 2 back-to-back quarters of declining real GDP? And then we took off. All I'm going to ask you, I'm going to leave you on this one. Was that or was that not the recession that everybody is fucking crying about? Definitely could have been. Guys, my name is Hamilton. Once again, I'm here with the Trading Initiative. If you like this type of stuff, please like and subscribe. Leave a comment below. Free newsletter goes out daily, linked below as well. And we are opening up a new market research portal, We are beta testing it right now. I will link it below. If you want to beta test it for a reduced price over 3 months, please feel free. Click on the link, read the description, and I'll see you inside.